The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. Volume's going nowhere, but we still have record highs. Let's keep that in mind.
It seems to be a familiar story.
I mean, really, yeah, especially Microsoft, Amazon. All right, here we are in the overall market. The S&P is making a run for it into the close at 0.4%, despite the fact the volume is still quite light. Digging beneath the hood a little bit, two really interesting things to think about. One is the home builders, that index down by 0.2%, but in beneath that, you have D.R. Horton, you have Lennar getting hit with a downgrade over at Citi and Raymond James to hold. They're worried about the Florida housing market, so that read-through is also quite interesting. And Paramount, it's like a dartboard. Who's going to buy the company? That stock up by over 5%. Apparently, Paramount is in talks to spell its Black Entertainment Network TV network for anywhere between $1.6 and $1.7 billion, Scarlett.
All right. Meantime, we're taking a look at these top stories. Auto sales hitting a speed bump. Tesla posting another quarter of falling deliveries, but the end result was less bad than anticipated. Overall, the industry is grappling with affordability issues as high prices and steep borrowing costs push consumers to wait if prices drop any further.
And a jolt for jolts. Job openings rise in May while the quit rate slows, and there are only 1.2 job openings now for every unemployed worker.
And Powell's progress report. The Fed chief says the latest data show inflation moving in the right direction, but central bank officials still need more proof before they can begin cutting rates.
So let's get right to it. Fed Chair Jay Powell, here's what he had to say from Sintra, Portugal.
We do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings. You can see the labor market is cooling off, appropriately so, and we're watching it very carefully.
Let's kick things off now with Tony Crescenzi, portfolio manager and market strategist over at Pimco, who joins us right here on set. Tony, good to see you.
Great to see you, Alex.
So you got the jolts, you got jobs coming on Friday, you have what Powell said in Sintra. We set up for 1 or 2 rate cuts this year?
Yes, and we think investors shouldn't overly focus on the timing. It's likely to happen eventually, and investors should just be patient about it. The important thing is that the interest rate's not likely to go up. So if investors are happy with today's interest rates and yields, and we are, call it a 5% type yield, 6% or more for high-quality bonds, then they should invest today and not wait for interest rate cuts. It's usually by then that it's too late to get to the start of the party.
There was some talk today after the jolts that any sort of increase in unemployment could actually lead to a faster increase in the unemployment rate, and that's going to put sort of speed up pressure on the jobs market. Do you see that happening? Is that a risk at all?
It's part of the idea of, there's an old adage about walking a dog with the long leash. That's the monetary policy. You can't really predict what's going to happen next. So with respect to the unemployment situation, it could get worse faster than you think. So if you think that moving the leash around faster to try to fix things, to move the dog, which is the unemployment rate, you might get it wrong. It's just difficult to coordinate, to get right. So the Fed's trying to balance the dual mandate, which is, of course, a focus on inflation and employment. And as Powell said today, it's becoming more balanced, the risks on either side of that dual mandate.
And you have the dog. You'll know.
Yeah,
I
keep a very short leash actually on the dog. When it comes to the Fed, is it looking at non-farm payrolls and U3, the jobless rate, as lagging indicators or leading indicators here?
Typically, it's a coincident indicator. It's telling you what's happening now. But the Fed can easily say, because of many different gauges, that policy is restrictive. And what do we mean by that? Where the interest rate is high enough that it's likely to lead to slower and slower economic growth over time and disinflation. That seems to be the case based on, for example, the JOLTS data you mentioned earlier. The job openings have been declining steadily. Didn't happen in the latest month, but they've fallen from 12 million to 8 million. So doesn't that tell us that Fed policy is likely restrictive, and that if it were to keep the policy rate here, what if that 8 million became 4 million in terms of job openings? We know that the level of unemployed is around 6.5, and that's not a good situation. The Fed wants to prevent that type of dilemma and get ahead of it because it does take time for conditions to turn around.
I'm looking at the economic surprise indexes, and whether you look at Bloomberg's proprietary index or Citigroup's proprietary index, exactly, it goes down, down, down. Economists keep believing that the economy is stronger than what the data actually show. At what point does that self-correct, and how much of that is priced in right now?
Well, markets, like the Fed, are a little bit confused, and the Federal Reserve is in fact confused because, for example, there's something called the ISM index. It measures either the manufacturing sector or the service sector. The manufacturing index has been below what they call 50, which is a negative story for the economy, whereas the service sector index has been above 50. Turning to the jobs report, the unemployment rate's been rising, but the monthly payroll figures, a separate survey, has been strong. So there's conflicting signals there. So the Federal Reserve's default mode is to play risk management and decide, well, we're really not sure about what to do. And it's something that Christine Lagarde said while she was in Sintra. She says the key thing now is to manage the risks that inflation expectations rise again because they could. Decide on a path to fix that, which is to raise interest rate, but to weigh the costs. She said those are the three aspects of the story, and the Fed's now weighing it all because they do have to think about the eventual costs of keeping the policy rate too high for too long. But they need to. Final word on this is the old Volcker-esque way. Paul Volcker, the legendary Fed chair, is to keep at it. Remember, in 2018, he wrote a book called "Keeping at It." The key lesson of history is to keep at it. Chair Powell's even reiterated that idea, to ensure that the job is done. So, in other words, the most important innings in the 9-inning game is all 9 innings for the Fed. They can't. There is no let-up that can be permitted to get the job done right.
So if what you say is it doesn't matter when the Fed starts cutting, that they just will, then does it matter what that looks like? Like, are we normalizing? Are we really cutting? Like, does that matter?
Well, it looks like for the U.S. economy, a return to the old normal, as Pimco might call it, where the interest rate is likely to be closer to historical norms at some point. The Federal Reserve, in fact, is forecasting that, forecasting the Fed funds rate, which is today around 5.25%, to eventually get to around 3.5%. Not zero. That's the important thing, because in the 2010s, in the aftermath of the GFC, the global financial crisis, it was zero, and of course, most recently. And so a more normal, old normal style of interest rates is likely, but the key thing for the bond investor is its total return time. You have to be thinking about the stated yield, close to 5 to 6%, the potential for gains in price that make the total return higher than that. And what investor would want to miss it? Blink and you could miss that move, and you've got to be careful about missing it.
All right, Tony Crescenzi is portfolio manager and market strategist at Pimco, and he is sticking with us because coming up, car buyers facing pressure from high prices, steep borrowing costs, and a cyber attack that hobbled dealerships across the U.S. We've got the latest numbers.
Plus, we're going to get insight on the global economic outlook and the impact of the U.S. presidential election. Our guest is Nouriel Roubini, CEO of Roubini Macro Associates.
And Alex mentioned this, Paramount Global in talks to sell its Black Entertainment Television network for $1.6 billion. We've got the latest on potential buyers. All that and more coming up. This is The Close on Bloomberg.
We are waiting for total U.S. auto sales for the month of June. They likely lost some momentum. You got high prices, steep borrowing costs, and the cyber attack that hobbled dealerships across the country. Joining us now for more is Bloomberg's Molly Smith, who covers the economy for Bloomberg. And Molly, I just wanted to get some insights as to the consumer pinch when it comes to, say, auto loans and that affordability part.
Yeah, you really see this in every interest rate sensitive part of the economy right now. This is happening as well in the housing market, too, that there's a similar dynamic going on of high prices, high borrowing costs when it comes to housing as well. And, auto dealerships and as well as home builders are doing as much as they can to provide incentives for consumers, but it's still just a really big ask. And if these are purchases that you can put off, consumers are definitely doing that.
Yeah, absolutely. I think about the biggest expenses any household has to bear. It has to be buying a home, paying for tuition, higher education tuition,
sure,
and of course buying a car. And of those, buying a car is a must-have if you have a job.
Totally, yeah. Of course, if you're also watching what's going on with New Jersey Transit right now, you probably want a car even more to be avoiding avoiding that. But these are steep payments. I mean, especially when you take into the totality of what owning a car entails. It's not just the payment on the car loan. It's also car insurance, which we know has been rising at an insanely fast pace, up like a 20% year-over-year increase in the CPI in the last few months. So that's been expensive. And similar with the housing market as well, that when you have a higher starting price for a home or for a car, it costs that much more to insure it.
What are we seeing on the delinquency front when it comes to the consumer because of these high loan rates?
Yeah, it's definitely creeping up, but you have to remember this was starting at such an artificially low rate. We had so much stimulus activity during the pandemic that really depressed delinquencies down to really, really low levels. So they are coming up, but you're seeing this still more in like the low single-digit percentage area of delinquencies, and naturally really affecting lower income consumers the most. So it's not really a widespread pickup just yet or anything that's really sounding the alarm.
Yeah, but the question is whether that's a slippery slope and, there's more to come. Molly, thank you so much. Bloomberg's Molly Smith covers the economy for us. We still have Tony Crescenzi joining us, portfolio manager and market strategist over at Pimco. And Tony, we talk about the consumer being pinched by these high borrowing costs, whether it's for your car or whether it's for your home loans. But we are starting to see evidence that perhaps people are coming to terms with these high borrowing costs. Definitely people are now, there's more activity in the housing market, and the average mortgage rate is a lot higher than it was just 3 years ago.
Right. In fact, about 15% of households now have a so-called weighted average coupon of 5% or more, and it's increasing by 1 point per month. So it's slow and steady. It's probably what the Federal Reserve wants. It doesn't want a sudden crash in the economy. It wants a so-called soft landing, so it's consistent with that. So the theories are, number one, the excess saving that built up during the pandemic and afterward is depleting. But there are points of resilience. Household net worth, the figure released quarterly by the Federal Reserve, shows household net worth up substantially. Just think of the stock market, think of home prices, big drivers of that. We're talking $50 trillion in 5 years to $160 trillion or so. It's massive, and it's helping the consumer to keep going. So all of this might suggest, as Molly said, some weakening in the economy is in the offing, but not substantial weakening, which is a Goldilocks type scenario for the equity investor, because it suggests cash flow for earnings, buybacks, and dividends will stay high and keep the game going.
I wonder how you see this playing out as we get closer to the November elections, because so much of how people vote depends on how they feel economically.
The dynamic there is that it takes a long time for changes in economic conditions to affect how people feel about the political dynamic. So it probably won't change significantly between now and then, unless there's a sudden change in the economy, either a sudden stop or a significant acceleration, and or a change in the inflation situation that changes perceptions about it. So don't look for that to change the equation too much.
So you mentioned how, yes, we've run down excess savings, but the household wealth has really grown. Does that good for the equity market? What about for the bond market?
For the bond market, it matters too, because investors own credit. In the Bloomberg Aggregate Index, which is a market-weighted index, about 40% U.S. Treasuries, 25% mortgage securities, and 25% corporate bonds, which is the point. Cash flow matters. In the end, that matters, because it's the cash flow, meaning monies that companies generate, that pay back the bond investor for interest and money back at maturities. And that confidence in the outlook for cash flows related to the economic situation is what's driving credit spreads tighter, meaning the yield difference between corporate bonds and treasuries. They're really tight, and it reflects the strength of the economy. So it is important, but we would say to a bond investor, you needn't step too far out in terms of interest rate sensitivity or credit risk to get a 6% type yield these days, 6% or more, so even 7 if you think about the global bond supermarket, 130 trillion of bonds. There's lots to do in the world. It's actually pretty exciting. Crank out your Fobosi book, the 1,500-page book on fixed income. Lots of little things to do to gain a little extra return above the stated yield.
That's this weekend's reading, clearly.
1,500 pages, all on that for July 4th by the barbecue. When you take a look at, say, the money then in money market funds, it's still earning 5%. How much of that money should stay there?
It depends on the individual, of course. That's a disclaimer. But here's the data since 1978. 90% of the time, core fixed income, maturities 5, 6, 7 years, like the Bloomberg index that I mentioned, the aggregate, they beat cash, like money market funds and so on. 90% of the time, by an average of 3 points per year over 3-year periods. In other words, and it makes sense. Imagine if yields fell a half point. The duration, 6 years, multiply that times the 50 basis points, and you get a 3-point price gain in these bonds with the 5, 6, 7-year type maturity. Add that to your yield of 5, and you could get an 8% return in 1 year, or spread it out over time. You can see a pretty good average over that period. So the timing is, and the final word on this is, the timing is usually best just before the peak in the federal funds rate, which we think is already in place. Mm-hmm. And I should add, finally, that the returns for core fixed income tend to be cash increasingly as the Federal Reserve embarks on its interest rate cut cycle. So it's too late to be tactical. As I said, it's time to be thinking about total return in bonds, the stated yield plus added gains to that because of price.
Hey, Tony, good to see you. Thanks
Great
for stopping in. Really appreciate it.
Great to be with
Tony
you.
Crescenzi, portfolio manager and market strategist over at Pimco. So I guess I need to rethink that money market fund at 6%.
You know, I like what he said about it's too late to be tactical. That's good advice in general for anyone who thinks that they can kind of like come in right when the timing is good and get out right before it turns, because that never ever happens. Once you get out, it's, you know, you never want to get back in because you're always worried.
Exactly. Yeah. And I'm like super paranoid. But it's also interesting too that the idea that if I made a lot of money, say in corporate bonds, and you were mentioning how household wealth is really ticking higher, you're just going to reinvest it.
Yeah.
So it's just going to keep spreads lower. I don't know. And then it's like a fulfilling prophecy. Anyway. All right. Coming up, a check on U.S. retailers as we kick off the second half of the year. We're going to get a view from the sell side about the trends in that he's seeing in our top call segment. This is The Close on Bloomberg.
Time now for our top calls. A look at some of the big movers on the back of analyst recommendations, starting with Lennar. The home builder hit with 2 downgrades today from Citi and Raymond James. The latter cites concerns around a softening Florida housing market where resale inventory is surging due to higher insurance rates and property taxes. That analyst cutting his outperform rating to market perform, shares down about 1.75%. Next up, CrowdStrike, a downgrade on the security software company to neutral from overweight at Piper Sandler. CrowdStrike is on a strong run this year, up more than 50%, making for a less favorable risk-reward scenario for investors, according to the analyst. The stock down almost 2%. And finally, PayPal lifted to positive from neutral at Susquehanna, which set its price target to $71. The analyst cites valuation for the upgrade and touts PayPal's dedication to profitable growth. He says PayPal's consumer-facing improvements should increase its value proposition for branded checkout. The share's up by almost 1.5%. And those are some of our top calls. Now, before we get to our analysts, we do want to clarify a call from yesterday. NextEra Energy Partners, ticker symbol NEP, was downgraded to sector perform from outperform at RBC Capital Markets. Our graphic showed the logo for NextEra Energy, ticker symbol NEE. So we're correcting this mistake on air today.
All right, let's turn to the consumer here. The first half of the year saw consumer discretionary sort of right in the middle of the pack for the S&P. You got everyone from Walmart to Nike flashing some warning signs about the health and financial health of U.S. households. Our next guest said he's neutral on apparel retailers. Joining us now with more of his insights is Zachary Warring, an equity analyst over at CFRA. And I'm looking for the year to date. You got Deckers Outdoor up 41%, and then Lululemon down 40%. How do you pick winners and losers in this market when it comes to retail?
Yeah, thanks for having me. So, you know, it's been tough. Deckers has done really well this year. Lululemon, not so much. We're really positive on Lululemon. We think investors and analysts aren't giving Lululemon enough credit for kind of past performance. We think their management team has continued to perform over the last 10 years, and we think they'll turn it around here. I think investors got a little scared from that first quarter report, where they kind of said the slowed growth in the U.S. is, a big deal. And I think it is, but I also think that they're able to grow in other countries and other parts of the world to offset some of that slower demand in the U.S. So, we like companies that have a proven track record of growth, and we don't like companies that have a very mature, saturated U.S. market with little in terms of growth aspects outside of the U.S.
Right. Okay, so I get what you're saying. You're thinking something like Foot Locker or American Eagle is more of a mature brand. But what about a mature brand that is in the process of reinventing itself, like Gap?
Yeah, so we have a tough time getting behind Gap. We've heard this story quite a few times over the last 10 years, and they've been through many restructurings and they've, a couple of times you thought that maybe they would turn things around and become more efficient on the operating side. So we have a tough time getting behind Gap. We know a lot of other analyst investors have kind of hopped on that train, but we're just, with us, we like proven track records for more than just a few quarters in a row. And so that's, we would probably need to see Gap, perform for a year or two before we really get positive on them. Like I said, they've got a lot of older brands that have saturated in the U.S. They have, they don't have any plans to grow outside of the U.S. really. And so, we don't like, expectations we think for Gap are pretty high.
Let's go to the fancy pants sector. You're talking Hermes, Ralph Lauren. You cover all those as well, including Kering, for example, Cartier. Does the high end, have they found their bottom, and is it time to sort of re-rate higher, or do you think the trough lasts a lot longer?
No, we really like LVMH. We think LVMH is cheap here. They've got proven growth over the years. Their margins have improved dramatically since COVID. When they bought Tiffany, they had a big boost to their operating margins because of the margins at Tiffany. And we just think they're a top player in luxury. So we think, their brands are proven, and we think, they'll continue to do well and perform well. And that's who we like within the luxury space. Kering's is a good stock as well, but we're not as positive on Kering.
I'm curious to hear from you in terms of operationally. We know that a lot of the supply chain issues have gotten sorted out, and freight costs are a lot lower, so that's now a tailwind. What kinds of companies are in a best position to benefit from that, to really take advantage of that?
Yeah, we actually think that the lower freight cost tailwind is almost done. We think the comps are starting to get a lot more tough. So going into Q3 and Q4, you started to hear a lot of these companies state, that they were seeing, major headwinds from lower freight costs. So we think you're kind of towards the tail end of that trend. And now we think, it's going to be up to management and how management at these companies can handle the growth and operating. So, that's why we continue to go back to who's a proven, what's a proven management team and who's proven over the last 5 or 10 years who can operate in just about any environment.
Absolutely. It goes back to strategy and execution and talent. Zach, thank you so much. Zach Warring here joining us for his take on the different consumer companies, as we've seen kind of a rough couple of weeks here for a lot of those consumer names with the latest anecdotal from their earnings.
Yeah, I don't envy his list. He covers like every single company out there. So to create one narrative must be extraordinarily difficult. But, Lululemon, okay, picking the bottom.
All right, coming up, we're going to get insight on the global economic outlook from the one and only Nouriel Roubini, CEO of Roubini Macro Associates and the famed NYU Stern School of Business Professor Emeritus. This is The Close on Bloomberg.
You can't really predict what's going to happen next. So with respect to the unemployment situation, it could get worse faster than you think. So if you think that moving the leash around faster to try to fix things, to move the dog, which is the unemployment rate, you might get it wrong. It's just difficult to coordinate, to get right. So the Fed's trying to balance the dual mandate, which is, of course, a focus on inflation and employment. And as Powell said today, it's becoming more balanced, the risks on either side of that dual mandate.
That was Tony Crescenzi, portfolio manager and market strategist at Pimco, speaking with us at the top of the hour. For more on the economic outlook, we're joined by Nouriel Roubini, CEO of Roubini Macro Associates and NYU Stern School of Business Professor Emeritus. Nouriel, it's really good to see you. Tony Crescenzi was talking about sort of the Fed is in risk management mode. Are they doing this right?
Yeah, I would say they overall are doing it right. On one side, they're still worried that the surge in inflation occurred in the first quarter may be slightly more than temporary, even if the latest number suggests a softening of core PCE. But now there's also something of a slowdown of the economy, something of a softening of the labor market. There is job creation, but the unemployment rate has ticked up towards 4%. So there is better balance and there is a slowdown in the economy. So based on their dual mandate, they have to worry about the inflation, they have to worry about growth as well. So I think they're right in waiting until they start cutting rates.
Nouriel, do you think that the risk should be more on the inflation side or the growth side, in that the risk is higher inflation or lower growth? Which camp would you be on?
Well, until recently, I would have argued that the biggest risk was upside on the inflation side. But now economic growth has slightly moderated. Consumption is slowing down. There is some slackening in the labor market. So I think that the Fed wants to achieve a soft landing, but not a softish landing. They don't want to go to 2% with even a short and shallow recession. And therefore, they have to start thinking also about the downside risk to economic growth.
Are we out of the woods yet in terms of we can avoid a recession? At most, we'll get a soft landing?
Yes, with one caveat. You know, a year ago, everybody worried about a real hard landing. Then there was a risk of a softish landing. Then people said, no, we're going to achieve a soft landing. But recently, there was both a growth above potential and inflation above target. So the risk was that actually the economy was growing too fast and will be in a no landing situation. And no landing will lead the Fed to stay high for longer or even higher for longer. That was the risk. While I would say that right now the softening on the growth and labor market side suggests that maybe the risk of a no landing is reduced and we're going towards maybe something closer to the goal of the Fed, that is a soft landing.
In terms of global economic risks and what might keep you up at night, I know that you worry about a lot of things and a lot probably keeps you up at night, but globally, when you look at what's going on in the Middle East or when you look at what's going on with Russia and Ukraine, what's happening in Europe with those elections taking place in France and the UK or China, what is the single biggest concern for you as it relates to how the Fed proceeds?
Well, the biggest risk would be some kind of geopolitical shock that will lead to some spike either in energy or broader commodity prices. The initial brutal Russian invasion of Ukraine led to a spike not just in energy prices, but also food, fertilizer, industrial metals. If there was a worsening of the conflict between Israel and Hamas, an escalation that includes Hezbollah and Iran, of course, there could be a spike in oil prices like the one we saw in the stagflationary episode of 73, 79. And the conflict with China is more of a slow motion, a build-up of a Cold War is getting colder, risk of protectionism. And of course, what's going to happen on the trade side depends very much on whether Trump is going to be elected or Biden or some other Democrat as well. So I would say all central banks worry about some geopolitical shock that spikes either energy or other commodity prices that will lead to an increase in headline inflation that could eventually lead to a second round effect of an increase in core inflation and be a stagflationary shock that the increase in inflation reduces growth in a way that will make it really hard the goal of central banks to achieve a soft landing.
Putting aside the U.S. election for a second, because we will get to that, what is the risk that we should put on the French parliamentary second round election and the result of that?
Well, there is certainly a risk that the party of Le Pen reaches an absolute majority. Their fiscal program, the program about Europe, is really, if implemented fully, something will be dangerous, not so just for France, but also for Europe. However, I feel that even if they were to come to power, they'll be moderated. They'll be moderated because there are constraints coming from the European Union, from the ECB. There'll be an cohabitation with Macron. And most importantly, there is market discipline. If they were to follow a reckless fiscal policy, there'll be a massive widening of their sovereign spread, a fall in the stock market, a weakening in the euro that then will force them to adjust. We know what happened in the UK, where the government of Liz Truss did not survive more than 44 days when the bond vigilantes came into action. So I would say the biggest constraint to a radical economic and fiscal policy in France comes from market discipline, and that's going to lead them probably to moderate if they come to power, if they want to stay in power. The alternative, a hung parliament, is not much better, because that hung parliament implies a minority government. One's going to be subject to a vote of no confidence, eventually a caretaker government, and to policy and political chaos as well. So either way, there are risks in France, but I think that market discipline is going to constrain whoever is going to be in power from doing things that are too extreme.
The rise of Le Pen indicates the rise of populist parties. Are there instances where populist parties are good for markets and for the economy?
It depends. Some of these populist parties start from very populist economic agenda, and then they moderate. In the case of Italy, Meloni, when she came to power, there were worries there'll be a loose fiscal policy, there'll be a reversal of structural reform. That did not occur. And some do hope that Le Pen can be, the way I put it, be Melonized, that once power is going to moderate. There are differences between Italy and France. The program of Le Pen is much more to the right of the one of Meloni. Italy had a carrot of 200 billion euros of low-cost loans or grants from the EU. And Draghi played the role of, paternal guidance. In the case of Meloni, there is not the same figure in the case of France. So they're not, I don't think that France will get under Le Pen fully Melonized, but they're going to moderate compared to what they are right now if they come to power.
All right, Nouriel Roubini is CEO of Roubini Macro Associates and, of course, of NYU Stern School of Business. He is sticking with us because when we come back, we'll get his thoughts on the U.S. presidential election and what that outcome would mean for the U.S. economy and the global economy. This is The Close on Bloomberg. We are back with Nouriel Roubini, Roubini Macro Associates CEO and NYU Stern School of Business Professor Emeritus, who recently wrote this about this November's U.S. presidential election. Quote, as the saying goes, it's the economy, stupid. Trump's proposed economic policy agenda is now the greatest threat to economies and markets around the world. Nouriel, when it comes to a lot of the policies, particularly towards China, Biden and Trump actually see eye to eye more than they are facing off against one another. But what you are pointing to is really the threat of increased sanctions and more protectionist policy, isn't it?
Yes, it is. Of course, Democrats and Republicans want to be tough on China. But Biden administration had a view of creating what they call a narrow yard with high fences and concentrating on some critical technological factors and sanctions, while the plan of Trump, at least at face value, is one of imposing a 10% tariff on all the imports coming to the United States, even from friends and allies like Europe, Japan, South Korea, you name it, and up to 60% on Chinese goods. So I would say that the big question mark is going to be whether it's going to head and do that, or whether it's going to offer some carrots and sticks, telling, for example, Europeans that if they spend more on defense or if they change some of their trade policies, they may be subject to exemption from the 10% tariff. Same thing for China. He may gradually increase the tariffs every month to reach eventually 60%. But if China does certain things, maybe he stops short of that. But the point is that any tariff is a regressive form of taxation. It increases import prices and it causes a higher inflation. What it could alternatively do, and people have discussed it, is the idea of, instead of a generalized tariff, to force other countries to accept the depreciation of the dollar and an appreciation of other currency, something equivalent to the what happened with the Plaza or the Louvre agreement. People talk about the Mar-a-Lago agreement on currencies. But that will be similar in terms of impact on inflation to a generalized tariff as well.
So, Nouriel, if we leave the dollar out for a second, what is the asset class that you think is going to have the most exposure to the volatility of the election based on the policies that we do know? Bond market, equity market?
I would say that protectionism is going to lead to a gradual increase in inflation, and that will be something will be of concern certainly to the bond market. but an escalation of trade friction or a generalized trade war with the rest of the world, because our trading partner might also impose tariffs against the United States, is also a threat to the stock market. A global trade war not going to be good for the stock market.
All right, Nouriel, thank you so much. We truly appreciate your patience and your time today. Nouriel Roubini, Roubini Macro Associates, CEO and NYU Stern School of Business Professor Emeritus. It was interesting. I was talking to Ira Jersey today of Bloomberg Intelligence, and he was saying the prevailing belief, if you have a Trump administration, that you will get that steeper curve, and because you're going to have higher inflation and less growth. He was also saying that you may also get, though, a more dovish Fed leader, in which case you might actually see a different kind of steepener and more buying in the front end as those front end yields come down, because you have a different dovish head of the Fed. Because President Trump would replace the Federal Reserve chairman with someone who's more amenable to his way of thinking, which is lower borrowing costs. Exactly. Across the board. It's interesting sort of different dynamics on what the steepener is, in addition to where in the equity market you might feel the outcome might be similar, but the rationale for it might be different. Yeah, exactly. And also, whether you're looking at bear steepers or bull steepers, I don't know, they steepen in different ways. It's a thing. Bear bull, Yeah. All right, coming up, Adam Turnquist is Chief Technical Strategist at LPL Financial. He's going to count us down to the closing bells as we look at a market that on the surface is making a little move to the upside here. The Nasdaq at a record up 0.7%, the S&P up 0.5%, also at a record. Volume, though, very light. This is the close on Bloomberg. This is Bloomberg's The Close. We are counting you down to the closing bell, about 10 minutes away. Here is where we stand. The S&P is a little higher on the day. The Nasdaq at a record, S&P at a record, Nasdaq 100 at a record, Microsoft, Amazon, and Apple all at records. You see the theme here. On the flip side, though, you have NVIDIA. That's really the tug on the Nasdaq here, down another 1.7% versus Tesla getting a nice boost higher. That push and pull, Scarlett, right there for the Nasdaq. It's another melt up, even though there doesn't feel like there's a lot of catalyst for pushing this market higher right now. Let's bring in now our stock of the hour. We're monitoring shares of Paramount after Bloomberg learned about exclusive talks for the company to sell its BET network. Sources say an offer was discussed with private equity investor Chin Chu for at least $1.6 billion. Representatives for Paramount and Chu declined to comment. Joining us for more is the one and only Abigail Doolittle. Well, thank you. That's a very kind introduction there. And Paramount once again in the news. I mean, we've been hearing so much about strategic alternatives for Paramount over the last few years. In fact, just this morning, Barry Diller said to be weighing some sort of bid for Paramount, the overall company. Now, relative to this piece of news, yes, they are said to be in exclusive talks with BT Networks for a $1.6 billion bid. And they are in those exclusive talks with the BET CEO, Scott Mills, and the head of CC Capital, Chin Chu. Now, BT Network was sold to Paramount's predecessor, Viacom, in 2001 for $3 billion. So this is a pretty big markdown from those levels. And it's not the first go-around. Byron Allen, I believe he had put together a $3.5 billion bid not so long ago. So that would have been an increase. Tyler Perry, but dropped out of those talks. And then when I was talking about Paramount, of course, not so long ago, Sherry Redstone, who has a controlling stake in Paramount, she walked away from a proposed merger with Skydance Media. Now, why they want these strategic alternatives? If we were to take a look at this chart from its peak back in 2001, down 90%, years of declining profit growth. So in terms of that declining profit growth, in the meantime, before potentially getting one of these deals done, because they really have to sign it for anybody to believe it, they are said to be working to cut about $500 million in costs. The stock right now, though, investors very excited, up more than 5%. All right, Abigail, thank you so much. Really appreciate it. Great chart there. Abigail Doolittle joining us. Let's get more market analysis and welcome Adam Turnquist. He's Chief Technical Strategist at LPL Financial. Hey, Adam, we were talking about the melt up in the overall equity market. Individual names definitely moving as well. Why this melt up?
I think it's just the momentum continuing in this market. It's relatively narrow. That's really what we witnessed over the last month and a half. We had a breakout through those March highs. However, underneath the surface of the market, participation pretty underwhelming. We had more 4-week lows last month than we had new highs. Volume underwhelming as well. Of course, the catalyst has been the mega caps, the Fab Five, whatever you want to call them. It's really been driving this market. And right now, technically, we're watching for a rotation to make to really make this rally sustainable. Haven't quite seen it yet.
You speak of the Fab Five, but really when it comes down to what's driving this market, whether it's the S&P 500 or the NASDAQ 100, it's really NVIDIA. When you look at the charts for NVIDIA, what does it tell you? And I ask this because, of course, it dictates how the S&P 500 ends up moving.
Absolutely. It drove about 30% or more of the S&P 500's total return this year. So it's been consistent leadership. Right now, technically, it did violate a shorter term uptrend. We had very low volume on this latest move to record highs, seeing a bit of a pullback and some shorter term technical damage that does raise the risk of a deeper pullback here. We don't cover the name, so making the technical observations that there could be some downside risk. Same thing in the semiconductor space. Very overbought on the SOX index. Recently hit 35% premium to its 200-day moving average. Momentum slowing a little bit right now. Historically, that suggests we could see a little bit of a pullback in the semi space. Extrapolate that into what it means for the S&P 500. Again, we could see a little bit shorter term of a pullback or at least a pause in this rally.
Well, what does it mean, though? Because over the last few days, what's been leading has been like Microsoft, Amazon, and Apple, and not NVIDIA. Can we sustain this kind of bull market without NVIDIA?
I don't think we can, at this level, this degree, when we're talking about one stock driving 30% of the S&P 500. It's been done before, but on a sustainable, longer-term basis and tactically, if you're looking to put money to work, we think there'll be a better opportunity in the second half. Some of these divergences in breadth are simply just too hard to ignore.
You know, I'm looking at the VIX. It's now below 12, 11.96. If you want to use that as your benchmark for volatility, we've got a low volatility backdrop, and we've got, as Alex was reminding us, record highs for the S&P 500 and NASDAQ. I know you've done some work that looks at what other periods in history resemble what we're seeing now. What did you find, and what was the outcome of those historical analogs?
So a few different things when we look at first on volatility. Historically, going back to the inception of the VIX, it tends to trough right around July and then ascend into, call it late September, early October is when it historically peaks. Election year, it peaks right around the election day. No surprise to anyone there. But from here on into the fall, the VIX tends to creep higher. In terms of seasonality and what this year looks like, interestingly, we ran a correlation analysis looking at the progression of this year, compared it to every single year, the first half of every single year over the last 70 plus years. And the most correlated is 1995. So if you flash back, that was a soft landing scenario. We had the dawn of the internet. The parallels there are to AI. So some interesting analogs to look back in terms of seasonality.
Yeah, that is really interesting, particularly, like you said, in an election year. Before we let you go, the Russell, it has just been stuck in this channel for the whole month of June, waiting for a better economic outlook to really start to outperform. Do we go back to the 200-day? What do you think?
It's range bound right now. Maybe you bounce off the lower end of that range near the 200-day. And that's another interesting chart when you think about the context of a bull market and it being sustainable. Small caps don't need to lead the bull market, but they should at least participate. We're not seeing that in the Russell or the S&P 600. Really just range bound for now. We think it should be neutral small caps until you see a breakout or a breakdown from that consolidation range.
All right, good stuff. Adam Turnquist, Chief Technical Strategist at LPL Financial. That was fascinating on the VIX and how it tends to hit its lows right around July. And, of course, it'll peak in November, but between now and then, anything goes.
Yeah, you can see the curve. It's really quite, if you do VIX, index CCRV. It's really nice to see that curve there. I go back to what Lori Calvasina said. Did you see this? Upgraded her S&P forecast, but she said she categorizes herself as a nervous and jumpy bull. It's like she can see the S&P going to 7,500 from 5,300, and that's where her upgrade was. But like she didn't like it.
Yeah,
It didn't make her feel good.
That's a really good way of characterizing what's going on here. We're making record highs. It's a melt up, but it feels very precarious. It just feels like there's not that much conviction in it, even as people are saying, yeah, we could still see it kind of moving higher.
Right. And you had a truist also saying, like, let's give the bull market benefit of the doubt. But that's not more like, go buy this market. It's not Dan Ives and tech.
Right. No. Where he said the party's going to go on until 4 a.m. and Apple just showed up. All right. We're moving closer to the closing bell. We've got full market coverage right here on Bloomberg Television across our various platforms. This is the close on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Alex Steele here. And, of course, here to take you through the closing bell with a global simulcast. We're joined now by Tim Stenovic and Katie Greifeld, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Right now, Tim, I'm looking at indexes at their session highs, save the Russell, but that's usually the case. And the VIX now below 12, so low volatility and a melt up.
Yeah, Katie was in here a little earlier talking about this being, I think she said, a boring week.
A little bit of a snoozer.
And I got to say, not so much of a snoozer when it comes to fresh highs for the NASDAQ 100, NASDAQ Composite, S&P 500. That's the direction we're going in right now. Yeah, volume's a little light.
But that's
on
the
this
thing,
Tuesday.
Is that we're at all-time highs. Volatility is so low. I saw some stat today that it's been 300 trading sessions since we saw a move of 2% or more to the downside. You think of just the volatility that seems like it's just vanished from the market.
Yeah, and we were just talking to a technical analyst that said you may see volatility towards the election, but from now until the end, forget it. And that's why you have like Lori Calvasina talking about the nervous, jumpy bull and upgrading her forecast for this year.
The jumpy bull.
Yeah, the nervous and jumpy bull.
That.
That's how she categorizes herself. On the same day that you see Truist talking about that the rally deserves the benefit of the doubt, but none of that feels like super, super strong conviction, guys.
Yeah.
No, it doesn't. And I guess in the absence of super high conviction and people waiting for any kind of clue from the Fed or from the data with the jobs number coming out on Friday, we're just kind of slowly pushing the indexes higher.
And speaking of, there are the closing bells. You're looking at record highs for the NASDAQ 100, and the S&P. Volume pitifully light, but we're definitely seeing the records all across the board. You have the NASDAQ finishing up by 0.8%, the S&P up about 0.6%, the Dow up 0.4%, Tim.
Okay, so far, year to date, the S&P 500 is 15.5% higher. Taking a look under the layers of the S&P 500, we did see 343 stocks, everything's still getting settled. Moving to the upside, 159 declining today, Scarlett.
All right, I'm looking at the sectors, the IMAP, and what you'll notice is a lot of green. There are some red spots, so let's focus on the decliners. You've got healthcare down about 0.4%, and energy losing 0.5%. Interestingly, oil prices started the day higher before erasing their gains and finishing lower. Among the big advancers, consumer discretionary and financials, each gaining more than 1%. Consumer discretionary getting a boost from Tesla. Communication services also up by 0.8%.
Okay, well, let's talk about some of those stocks that were pushing IMAP segments into the green today. I do want to start with shares of Tesla, finishing the day higher by more than 10%. They extended their gains for a sixth day in a row. It's the longest winning streak in about a year. The company earlier today did report deliveries for the second quarter that beat the average analyst estimates. They were not higher than they were a year ago, though. Sales were down 4.8% from a year ago. Tesla did improve when it came to a sequential basis in the vehicles that were delivered in the vehicles that were delivered in the first 3 months of the year. Tesla's up a little over 25% just in the last 6 sessions. Still down, though, about 8% so far this year. Not the only EV stock moving higher today. Shares of Rivian also moved higher. Speaking of car deliveries, beating estimates. Shares higher today by about 7%. Rivian shares soaring after the company reported deliveries for the second quarter that beat its own expectations and Wall Street estimates. Look at these numbers, though. Delivered 13,790 vehicles. They did see deliveries between 13,000 and 13,300. So a really small number compared to other players in the vehicle space, and certainly compared to Tesla. Rivian's still down more than 30% so far this year. And finally, Paramount Global shares gained after Bloomberg News reported that the company is in exclusive talks to sell BET to buyers that include BET CEO Scott Mills and Chen Chu, who run the private equity firm CC Capital. Paramount shares were also higher earlier in the session. This was after the New York Times reported that Barry Diller was considering making a bid. When is this going to be bought? Because
I know, right?
Think about all the different companies and individuals who've circled this company.
Who hasn't been mentioned?
Yeah,
well, exactly. I was talking to Paul Sweeney, recovering media investment banker for media, and I was like, if you're in this stock, why are you still in it? And he's like, you're just waiting for the $20 share bid. And it's like
waiting and waiting.
I mean, everybody, it's pretty remarkable what we've seen. It's been sort of around the world, right?
Eventually, that story will reach its conclusion, maybe sometime soon. We'll have to keep watching that one. Let's move on to some of the decliners, though. Have to talk about NVIDIA, of course. Biggest points contributor to the downside on the S&P 500 today. Don't have a good reason why, but I will note NVIDIA, of course, has run into some turbulence over the past couple weeks. Since June 18th, this stock is down nearly 10%. And you think about the S&P 500 still hitting record highs, maybe speaks to how resilient this market has been. So that is the biggest company, one of the biggest companies out there. Let's talk about some little ones. I did want to talk about First Watch, actually, or rather, let me go back to Webtoon, because Webtoon, it IPO'd last week. It might not be familiar to our audience yet. It's an online comics company listed last week. It had quite a debut, but shares are taking a little bit of a dive today, down about 7% on the day. And we'll end with First Watch. So this is a restaurant group. You had shares fall as much as 6.2%. That's after Stifel cut its price target to a street low, basically citing concerns about foot traffic. So it's been interesting to watch that consumer worries about the consumer work its way into some of these specific names as well.
All right, looking at the bond market here, you're seeing definitely a bid. Yields coming down, particularly a little bit there in the back end. I mean, not a ton of news here, guys. We've seen a sell-off over the last few days, so no surprise that you might see some buying. We were talking yesterday about the 10-year hits 4.5%. Maybe that could bring in some of the buyers. We were talking, guys, to Pimco's Tony Crescenzi, and he's like, go for the yields on high-quality bonds. They're attractive enough. It doesn't really matter when the Fed cuts rates. Don't focus on the timing. It's going to happen. Just be patient.
Okay, I want to shift gears a little bit, guys, and talk about something that's a little more close to home, I think, maybe for Alex and me and Katie, Scarlett, you too, of course. I think we all consider ourselves New Yorkers.
Kind of froze you out there, though.
Well, I live in the suburbs, so I get why he did that.
Somewhat. But, you spend a lot of time in New York City. You've heard a lot about the financial constraints facing the city, and over the last 4 years, the concerns about the city's budget. We've seen closures of libraries on certain days here in New York City, trash collection getting curbed, the frequency of that. Well, it turns out for a fourth year in a row, NYC's finances keep beating the doomsayers, and it's just not as bad when it comes to the budget as originally thought, Katie.
Yeah, the final budget is going to be $112 billion for the fiscal year that started on Monday. So the good news is that that's going to help the libraries open up again. And in addition, give some of the cultural institutions back some of the money that had been part of the cuts.
And trash pickup will be resumed. And that's important, obviously, for everyone, as well as early childhood programs will recover about 3/4 of the planned $400 million in cuts that they had put in place or were about to put in place.
Is this just all taxes? Like they just made more in taxes over the last 3 years than they thought? Is that what this is?
Part of it had to do with that, but part of it had to do with restrictions that were put on limiting stays of migrants because there was so much spending on migrants in the city.
So they spent less on that and they had a little bit more money left over.
Yeah, exactly. Less than they anticipated.
Makes sense. Okay.
Yeah. We talk about how this was a pretty bullish day for anyone who was long the stock market, except if you had a lot of exposure to the likes of Eli Lilly or Novo Nordisk, because President Biden and Senator Bernie Sanders published an editorial today talking about how they need to lower the cost of their anti-obesity drugs. And if they don't do it on their own, we will do it. We'll do everything in our power to end it for them. My contention on this is for people who are having a difficult time getting the prescriptions for these anti-obesity drugs, they're going to the synthetic forms, right? They're going to the compounded versions of the drugs, which are a lot cheaper than what Eli Lilly or Novo Nordisk charge.
Also, it just raises questions, and I don't actually know the answer to this, but how other countries wind up pricing drugs, because if it's a socialized medical system, is the government in essence just paying for it, in which case you're paying for it through taxes, and this is a different way of offsetting it? Like, I literally don't understand how that works. So is it an apple to apples comparison?
And one of the companies that has just, made so much money from this is Novo Nordisk, which is not based in the U.S. So you wonder to what extent the Biden administration has the same power that it would have over an Eli Lilly, which is based in Indianapolis.
These are all really good points. I will say there was some a little bit of pushback from the sell side. If you take a look at Mizuho's reaction, they said that when you think about the benefits that these drugs bring and the fact that, it is an injectable, those tend to cost a little bit more. The price of around $1,000 a month actually seems very inexpensive. Obviously, $1,000 a month, that a lot of people right now can't afford that. But again, just thinking about it holistically and how much other drugs cost, it was interesting to hear a different perspective there.
Also, an editorial in USA Today is how the president and then Senator Bernie Sanders communicated this to people.
It's an election year, man.
Talking to the people.
Yeah.
Talking to the people.
It certainly is. Hey, are you guys going to be here tomorrow at same time?
We will
same
be.
place?
Yeah, we'll be here.
Really?
But we won't be together, but we'll be here on TV.
Yeah.
Same place, but different time.
Okay, typically what I say here on a Tuesday afternoon would be, we'll see you tomorrow, same time, same place. But we got a holiday shortened trading day coming up tomorrow. So we're going to take a little break from our closing bell coverage, but it'll be a little bit different. So we'll see you tomorrow, not the same time, but the same place. Have a good holiday, everyone. This is Bloomberg.
All right, coming up, Jessica Caldwell, head of insights over at Edmunds, will be joining us to break down Tesla deliveries, plus all the other auto sales for June that we got. We're going to break all that all down. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Dale. Let's take a look on where markets closed out the day. The S&P up 0.6%, closing at a record high and around the highs of the session as well. Volume, though, very, very light. And you can see that reflected in the VIX. I feel like it's been 12 forever. You're seeing some volatility priced on the curve for the election, but definitely not right now. A little bit into the bond market, but nothing to write home about. And crude taking a little bit of a break, was around a 2-month high. That was moving the equity market, but taking a break today, Scarlett.
All right. Not taking a break today is President Biden and Senator Bernie Sanders pushing for drug makers to reduce the cost of their anti-obesity drugs. They published an op-ed in USA Today targeting Eli Lilly and Novo Nordisk. And so these are among the two decliners in today's overall up market. You have Eli Lilly losing about 0.8% and Novo Nordisk's U.S. shares closing down 1.7%. Just a point of note that at the same time, there was a separate news headline that the FDA approved Eli Lilly's Alzheimer's treatment. So that is good news, certainly for the company and from those who suffer from the disease. Tesla up 10% on the day, the best performer in the S&P 500 and NASDAQ 100. This is after it reported its second straight drop in quarterly deliveries. But analysts said that the drop was not as steep as they had feared. So sales fell 4.8% for the quarter versus last year, but it actually improved on a sequential basis from the first 3 months of the year. And that brings us to our top story this hour. Tesla is trying to turn the corner. The EV leader reported sales falling, as I mentioned, for a second straight quarter. We're going to evaluate how much of this is due to Tesla-specific issues like a stale product lineup versus industry-wide issues of steep financing costs, as well as a crippling cyber attack across auto dealerships.
Yeah, but, Scarlett, we did see Tesla have a monster run before the close, up at 1.10%. Want to get more on Tesla's car sales with Bloomberg's Keith Naughton. Hey, Keith, is this a case of actually Tesla doing well, or is this a case of just not bad as feared?
Not bad as feared is clearly what the story is. Sales were down 5%, as you guys said. They've been down 2 quarters in a row. We're in the middle of this EV slowdown. So there is this broader industry trend that is having a negative impact on Tesla sales. But as you mentioned, Tesla's lineup also is growing stale. Their biggest sellers, the Model 3 and the Model Y, are getting long in the tooth. And the Cybertruck, which is its newest model, is pretty high priced and selling in pretty low numbers so far.
We also know that Elon Musk has announced major staff reductions. He's pushed internally to reduce headcount by up to 20%. Do you think that had an impact on its actual performance?
He did get rid of some salespeople, and salespeople help move the metal. So it could have, but I think these other factors probably had a bigger impact. Americans in particular are buying fewer electric vehicles because we're reaching that sort of mainstream part of the market that feels like EVs are too high priced and that the charging infrastructure isn't developed enough. And then again, Tesla's models are either too high priced with the Cybertruck starting around $81,000 or they're getting too old.
What about the broader auto market in terms of the car sales? You mentioned we get Ford tomorrow. But what have we learned so far about the overall auto market, not just EVs?
It's a little bit of a mixed bag. We expected really a bad month because of this cyber attack on the dealership software company CDK. But, it turns out GM was up a little bit, Honda's up a little bit. So it's better than expected, sort of like the Tesla numbers. So far it looks pretty good given this, big disruption they had with the CDK hack.
When we come back to Tesla and EVs overall, we know that the tax credit that the federal government offers tends to be something that incentivizes car buyers to purchase that Tesla. Is that still in effect or has that phased out?
It's still with us, $7,500 tax credit. And that is definitely a stimulus, particularly in these times of higher interest rates. The average interest rate on a car loan is now at 10%. So any sort of discount you can offer, and car makers are offering things like, discounted financing, subvented leases. So if you can toss in a federal tax credit on an electric vehicle, that definitely helps.
All right, got it. Thanks so much for that setup. Keith Naughton telling us more about Tesla and the stock rising because the second quarter sales were not as bad as feared. Let's now bring in Jessica Caldwell, head of insights at Edmunds, to further this discussion. Jessica, when it comes to a company like Tesla, how much is it suffering from its lack of products, specifically not having a hybrid vehicle, for instance, where the price point is much lower than EVs?
Yeah, I mean, they're not going to get a hybrid, but I will say that, of course, a older product lineup, like Keith had mentioned, is an issue. Americans expect something fresh every few years. Having a vehicle that's been around and does largely look the same for 6 years is just not something that's done. And when you think about that mainstream market that they need to appeal to, they need visual differences. There could be software updates and some, smaller changes, but people need to see something different. And especially for those early adopters that bought Tesla because they wanted something that was the latest and greatest and coolest thing out there. Having a vehicle that is old and especially in large metro areas, like completely oversaturated, is not something that appeals to them. So they really do have to move the product along to gain new customers and then appeal to existing customers.
I like the way you put that. They need something noticeably different. It can't just be incremental upgrades like the difference between an iPhone 15 or an iPhone 14, better guts inside, but it doesn't look any different. I want to talk about the broader auto market overall. When we look at the kinds of cars that are moving, that people are willing to spend on, in spite of high price tags and high borrowing costs, what's the common thread here?
Yeah, I mean, that's the issue, I think, with the car market. I mean, people want, left to their druthers, Americans want larger SUVs and trucks. We know that. However, in the land of high interest rates, that's just not possible for a lot of folks. So we are seeing people having to downsize, and that's why we've seen such strong performance for vehicles like compact SUVs. Hybrids are interesting because they are really popular right now. But when we actually look at the transaction prices, they're very close to MSRP. So if you're looking at a hybrid, sure, it may be less than an electric vehicle, but you're not going to get necessarily a deal because there's so much demand there. So I think people are just having to shift some of their preferences of what they truly want to be real affordable and more economical in this, in this financial situation.
Hey, Jessica, what do rates need to be in the economy for car sales to make sense, even at a higher price point?
Well, when we saw, rates are going to change according to, your credit score. But when we saw more incentives, and automakers were really good at this pre-COVID, offering things like 0% financing for 60 months, 72 months, and at the start of COVID, 84 months. That really moved the metal. I don't say that's necessarily a healthy business practice across the board, and especially for prolonged periods of time. But when you saw interest rates that were averaging below 5%, I would say that people felt, a bit better overall. There's still folks with bad credit that are, paying much higher interest rates. But I want to say when you can get people in at, something promotional under 3, that's when people start to take another look at your product. And any automaker that is running an offer right now with low interest rates and for an extended APR, not something for 36 months or 48 months, because that's too short for most people, they're definitely going to get more eyeballs than they did in the past.
Wait, is that actually happening? Because that's a good deal.
Not in a lot of places. You will see pockets of the market in which you are seeing lower APR offers, but to get a 0% loan for 84 months, we don't see that. But there is a small percentage for 0% happening. It's just at a shorter time period. So you're going to get a much higher monthly payments, which we know Americans are not fond of.
We know the Chinese EV space is thriving, and those car makers are selling, and at certain points they overtook Tesla. As an American, though, we don't have access to those vehicles. We know that the administration has been pushing back against that, proposing 100% tariffs on some of those Chinese-made EVs. In what way does that influence the offerings that are available to Americans?
Well, I mean, I think that is sort of that, interesting point is that people see these, BYD vehicles for $10,000. I mean, it won't necessarily come to the United States for that price, especially when you look at crash test regulations and some design regulations. That's not necessarily going to happen. But we do think that there's obviously an appetite for lower price EVs, but the quality has to be in balance because when we look at what Americans want, they don't want a small econo box with no features. Mm-hmm. We like all the bells and the whistles and the gizmos and the gadgets and all of that. So the vehicle still has to deliver on quality, but also content too. So it is that fine balance between something that is cheaper, but offers all that too. So I think what people are looking for is sort of that value messaging of getting a good price, but also getting everything that you want and not making compromises on that front.
And also cup holders that hold my big water can thing.
Yeah, your Stanley Cup.
Big. It's very difficult. Yes. All right, Jessica, before we let you go, we do have a presidential election. The rumor mill is President Trump gets in the White House. Those EV subsidies are the first to go. What do you think happens to the EV market then?
That's going to be tough because when we look at EVs right now, so many of EVs are being leased. I'd say, almost 70%. And that is because of the federal subsidy. So I think that the new car market would definitely be in trouble if that happened. And people that would be interested in EVs but need a cheaper vehicle are going to be onto the used market. But that would be a big detriment to lose that tax credit on, especially on the new side.
Yeah, really well said. Jessica Caldwell, head of insights at Edmunds. Alex, I know you guys drive on the weekends sometimes to Massachusetts. Would you ever buy an EV?
Yeah. We definitely think the next car will be an EV, but we need to manage.
How long have you said that, though? The next car will be an EV?
No, just one car ago.
Okay.
Because we just need the range thing. And also in Massachusetts, it's so cold. So we need to make sure the battery cannot die.
Right.
But we're definitely interested in it. Maybe
I think that's the way I feel, too. Like, definitely interested in it, but I don't have a garage. So how do you charge this thing? And the range anxiety is a big deal.
Yeah.
I definitely don't want to be caught out not being able to charge that thing, which is why when I need to rent a car, there's no way I'm renting an EV. It's just one too many things to worry about.
Yeah, no, that's a fair point. But I'll ride in them in an Uber.
Yeah, for sure. Once I figure out how to open the door and, close the door.
Yeah. Now
separately. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up, Jason Tatum. The Celtics forward set a new NBA record for largest contract ever after agreeing to a 5-year, $314 million contract extension. It helps that he helped the Celtics win the national championship.
Oh my God. What happens when the Celtics sell? Aren't they on the market now?
Yes, they are on the market. Yeah, good linking of the news. I know you don't follow basketball.
Yeah. No, she showed me her paper, guys, with the notes. That's exactly what happened. No, but seriously, what happens if they sell?
I mean, he signed, right? So he's going to be there. That's part of the appeal of the club. I mean, this is the fourth most valuable franchise in the NBA after the LA teams, after the Knicks and everything. But this is a team that has won the national championship, and they're going to make sure that they can hold their core together. And this new contract ensures that Tatum will stay there through his prime.
All right. Well, let's stay with money. Steve Ballmer, former Microsoft CEO, is now the sixth richest person in the world, passing Bill Gates. Apparently, more than 90% of Ballmer's $157.2 billion net worth is in Microsoft shares. This is according to the Bloomberg Billionaires Index. I did not know that.
He is highly, highly, highly exposed to Microsoft in the market.
But about half his wealth is held through Cascade Investment, and that was created with the proceeds of Microsoft stock sales and dividends.
That's Gates, I think. That's Bill Gates.
That is Bill Gates, as it says in the story.
Right.
You're absolutely right.
No, but what's interesting, of course, is that the former CEO of Microsoft, is wealthier than the co-founder of Microsoft, which, you would have thought the co-founder would be at the top of the heap, but he cashed out a lot of that.
He did cash out.
So, and also he is part of the Giving Pledge, where they have to give away most of their wealth. Warren Buffett signed it. Mm-hmm. Steve Ballmer notably did not sign that.
Interesting.
Yeah, he has other philanthropy efforts, but nothing like the Gates Foundation. Not that part, exactly. All right, third on the docket is Jay-Z. The hip-hop musician became the latest celebrity backer of the online watch market by taking an equity stake in luxury trading platform WristCheck. This is based in Hong Kong, and what we can tell you is that WristCheck targets buyers and sellers of high-end wristwatches in Asia and also provides authentication services to root out fakes. You know, when I lived in Hong Kong, every banker there seemed obsessed with making sure that they got a really nice watch. And I couldn't figure it out, but I think a lot of it is tied to the fact that Hong Kong's a duty-free port, so you don't have to pay taxes on those fancy watches.
But I don't think it's even just Asia. I think in general, like the watch market, luxury watch market, and the resale market, even in a downturn, is still relatively hot. Even if the prices come down, that resale market's huge.
No, that's a good point. I'm talking about junior bankers, though. Everyone was like, oh, I'm going to get a nice watch.
Oh, okay. Like you're not making $1 million. All right.
Yeah, there you go.
Let's stay with luxury here. Glenn Fogel, CEO and President of Booking Holdings, will be joining us next. This is Bloomberg. $32 million. That is how many people the Transportation Security Administration is expecting to screen at U.S. airports during this July 4th holiday period. That's up 5.4% from last year. And this is music to the ears of companies like Booking Holdings that already was forecasting a pretty solid year after a pretty solid first quarter. Their top and bottom line beat in the first quarter, and they were talking about the strength of international travel. So does this trend actually hold? Glenn Fogel, CEO and President of Booking Holdings, joins us now. Hey, Glenn, some analysts called your forecast for this year conservative. You had pretty good guidance. What's your clarity for the back half of the year as we enter the summer?
Well, you know how we are. We're talking end of the quarter, so I will stay where we were with what we said in our last earnings call. But certainly the numbers you put out were good. You're talking about July 4th weekend. People are going to the airports. They're traveling in the States. Of course, we're very global. So, you know, it's great having a good July 4th, but you got to think what's going on elsewhere.
Yep, and what's going on elsewhere, a lot of the action is over in Europe. Bernstein in particular talked about the Taylor Swift effect and that you, among other companies, would really feel the effect in Europe as she toured. Have you noticed increased activity around Taylor Swift tours?
Well, you can notice it when she's performing in a smaller city. You can see the cost of a hotel going up. You can definitely see it more easily than a large city. I think she's performing tomorrow, I think, in Amsterdam. I didn't look at the numbers, so I'm not sure. I was in Amsterdam last week. I should have stayed. I came home Friday.
Yeah, it's one of those things that after last year, which kind of surprised people, including members of the Fed, how much Taylor Swift moved the needle in different local regions, that people are now anticipating the effect that she'll have on not just those cities, but on companies that, you know, offer travel services as well. I want to ask about the Olympics, because obviously Taylor is going to perform in Paris, and you also have the Paris Olympics there. Do you notice any is there a meaningful bump from the Paris Olympics, either before it or after it?
Yeah, it's interesting. And I've been in the company now over 24 years. And it's interesting to see the Olympics each time, people thinking there's going to be this huge amount of people traveling to that city. But the effect is actually a lot of people who normally would go to that city decide not to go. So right now, you may have seen Air France came out with a news piece, I think yesterday morning perhaps, talking about actually less people going to Paris than they thought were going to go. Because, of course, unless you're going to the Olympics, you say, why would I want to visit Paris during the Olympics? And that's an effect.
Yeah, that's true. I mean, it's always a great time to visit Paris, but maybe not during a crunch time. Alex, I know that you follow EU regulation from the time when you're covering the European close, and anytime there's regulation, the EU is ahead of the curve over the U.S., especially when it comes to digital privacy and digital competition, ensuring there's sufficient competition.
Lots of sticks, not a lot of carrots. And Glenn, that definitely, you've been in the middle of that. New EU digital rules have kind of forced it to allow hotel companies to offer lower prices, not just on your website. Have you noticed the effect of that? What's that transition like right now?
So you're talking about the Digital Markets Act, the DMA. And one of the things it got rid of was a thing called price parity. And the issue had always been, this is an agreement with us and our hotel partners coming up with a way to make sure that we would have something in partnership the DMA says that you cannot have this price parity. So now there's more competition according to the DMA. Look, we are absolutely fine with following whatever the rules are, and we will compete as vigorously as we always have. There have been countries in Europe that have had rules that say you can have parity in the past. So in those countries, we would have seen an impact. We really didn't see much of an impact, so I'm okay with it.
All right, we got through July 4th, Taylor Swift, Olympics, and digital rules. Give me some broad strokes. Where are people going? How much are they willing to spend right now?
Well, where they're going depends on where you're from, of course. The United States, some interesting stuff. It's summertime. People want to go to the beach. Some of the numbers I've been seeing, places like Myrtle Beach, Ocean City, Destin, obviously all beaches, Panama City. And then they're the favorites, Las Vegas. People always want to go to Vegas. People are still going to Vegas, and people are going to continue to go to Vegas. Those are the popular things. U.S. people going outbound, they may be skipping Paris, but Barcelona, for example, up 70% year over year. That's an interesting number to see. Obviously, London, always a popular place for Americans. The big long-term thing, as always, is if GDP goes up, travel goes up more. And I think in the long run, this is a great industry to be in because we have seen decade after decade more travel, and it's just good for us.
Yeah, especially since you have a strong U.S. dollar as well. That's certainly a tailwind for any American going abroad. I'm curious to get your take on this idea of coolcations, where people are going to places that are not as hot, especially with climate change raising temperatures around the world. They're looking for locations where you can stay cool. I know San Francisco, for instance, has really marketed itself as the coldest summer that you've ever spent, being in San Francisco as opposed to being in another part of California.
Yeah, no, there's no doubt about that. And interesting, in Europe, you'll see that where people are trying to promote Scandinavia. It's cooler up there than it would be, say, the south of Spain. So there's definitely that. People are always going to try and market. What do they have that's a differentiator that people will want? And there's no doubt whether being in, going to San Francisco in the summer is definitely going to be cooler than being down in LA in the summer. So certainly that's the way things are. People are going to market it. Myself, they're always interesting places to go. And if it's too hot, there are places you go indoors to be cool for a while.
Yeah, very well said. I want to get your take also on Bank of America publishing a report that highlights companies that are candidates for splitting their stock. I know you'll be reporting your earnings August 1st, and so you can't say anything to the effect of whether you would split your stock or not by that date. But I'm curious to get your take on what it means to have a lower per share price in terms of attracting individual investors, because it doesn't actually change the valuation, but it may look like it's cheaper to those who want to get in on just a couple of shares.
Yeah, I have to agree with you. Slicing up the pie into more pieces does not make a bigger pie. That's absolutely true. Now, there is some psychological impact for some people. I've heard that. I've looked at the finance studies over many, many years. Long term, it's not going to make much of a difference. One issue that could make a company want to split is because their employees see it differently. So if you're giving out equity and you're giving a person just one share, or even when our share where it is, it's, you have to round off. We're up close to 4,000. You have to figure out which way we're going to round on that. It's not a big deal. In addition, and this is something that was not around when I was in banking, but fractional shares are easy to buy in the U.S. If somebody doesn't want to buy a full share or doesn't want to have a round number of shares, it's easy enough at many of the platforms to buy fractional shares.
Oh, that's a really good point. I hadn't thought about the employee angle. Fantastic context. Glenn Fogel, really appreciate your joining us today, CEO and President of Booking Holdings. Happy 4th of July to you. And it looks like Glenn is staying in New York for now. He runs Booking Holdings, but he's not necessarily traveling too far, at least at the moment. For those who are driving, there's some numbers on the latest car sales and a little bit less robust than what people anticipated.
Oh, nice segue. Look at what you just did there. You're taking a look at U.S. light vehicle sales coming in at 15.29 million. The estimate was for 15.8 or 0.9, depending on which survey you're looking at. So definitely a disappointment there. I think we get Ford tomorrow, so that will also be kind of interesting.
Yeah, absolutely. So if you take a look at what happened during the close, Tesla was a little bit of an outlier in that it was consistent with the idea that sales slowed, but it was not as bad as anticipated, so the stock went on a tear, up 10%, the best performer in the S&P 500, the best performer in the NASDAQ 100. Crude oil has had a really interesting move today, right? At one point it was at a 2-month high, but then it flipped it completely.
Gave up a little gains. Yeah, we'll have to see if we can continue, though, the strength that we've seen. Some saying it's really actually demand at this point, which is a big flip from what we've seen a couple months ago.
All right, and the S&P 500 record high, yawn. It seems like that happens every day.
32 record highs now for
she's
this
keeping
year.
Track. This is the close on Bloomberg.
Calls for President Biden to withdraw from the presidential race are picking up, with House Democrat Lloyd Doggett saying instead of reassuring voters, the president failed to effectively defend his many accomplishments and expose Trump's many lies. Joining us now is Bloomberg's Joe Mathieu, a co-anchor of Balance of Power. Joe, was this a surprise for Democrats to start to break ranks like this?
Not so much. And so far, it's one Democrat, I guess, to be technical when it comes to Congressman Doggett here, a member of the House, just sort of saying out loud what everybody else is saying behind closed doors for the most part. We talked earlier with Congressman Seth Moulton, who's a Democrat from Massachusetts, who I'll remind everybody actually ran for president in 2019 and 2020. Didn't get very far in that exercise, but he's been seen as kind of a new generation of leadership here. He also ran for House Speaker at one point, combat veteran. He acknowledged this. He didn't have anything, while he supports Joe Biden, to say that really turned this conversation around. He made it clear that some very difficult conversations are being had right now, and they frankly have not figured out exactly what to do. I would point you to this Friday interview that Joe Biden has agreed to do with ABC News. It's going to be conversations like that that help determine the way forward.
Oh, wow, because the president has not had those kinds of interviews at all, right? If anything, they've really been careful about making sure that he speaks to media in a very controlled environment. Like, it's not kind of an off-the-cuff thing that he does regularly.
Yeah, and frequently with a friendly audience here. And we see this on both sides of the aisle. You talk to the cable news network that matches your political profile. Joe Biden did a 60-minute sit down, but he hasn't held a lot of off-the-cuff live interviews, certainly, and he doesn't do a lot of news conferences. We don't see this president in the East Room pointing to a forest of hands, answering questions from reporters. It hasn't been the style of this White House, and it might be something that changes.
Going to the other side here, former President Trump, and sort of moving forward after the Supreme Court immunity case yesterday. What's been the follow-on on that?
Well, my gosh, quite the day for Donald Trump here. I suspect he didn't imagine that he'd get this headline when he woke up this morning. But the sentencing in the New York hush money case, this is the Stormy Daniels trial that brought us to Lower Manhattan for many weeks on end here. That was scheduled for next week, the 11th. That has been postponed. And we have a new date, September 18th. And that is because of the fallout from that Supreme Court ruling yesterday, calling into question whether it's possible to charge a president for anything that he's done in his official capacity, or she, in the future tense here when it comes to the presidency. That means that Donald Trump will be sentenced after the two political conventions and after a second debate, if there is one. It's scheduled for September 10th. And I have to be honest, after last week, it's unclear whether that's even going to take place.
Yeah.
All right. Good stuff. Bloomberg's Joe Mathieu, thank you so much for giving us the full backstory here on what's going to happen moving forward when it comes to the presidential election and the positioning after that Supreme Court decision. I want to bring in some headlines here on Apple. It is set to get an OpenAI board observer role as part of its partnership with OpenAI, their AI pact. Apple veteran Phil Schiller will take that OpenAI board observer role. So again, Apple will get an observer role on OpenAI's board as part of its agreement that it announced last month, further tightening the ties between two companies that early on people didn't think would be teaming up in any way.
Yeah, no more frenemies.
No more frenemies, at least for now. But, this is tech, so
who knows?
It could change very quickly. All right, let's move forward with our Muni moment right now, because a nonprofit known as Texas Biomedical Research Institute worked on the first vaccine for COVID-19 and a treatment for Ebola. Now it wants the municipal bond market to help it prevent the next pandemic. Joining us to explain is the CEO of Texas Biomedical Research Institute, Larry Schlesinger. Larry, thank you so much for joining us today. I really appreciate your taking the time to speak with us. Your organization actually sold bonds 3 years ago in 2022. How does tapping the muni bond market help you further your institute's mission?
Well, thank you very much, and good to be here. We're a nonprofit research institute in San Antonio, Texas, and we were founded in 1941. And really, we operate as a global infectious disease research institute with a very interesting model where we do fundamental research, but we also are able to work with a number of partners in a regulated science way to produce new countermeasures to infectious disease threats. During the pandemic, we actually accelerated our growth in the national and international markets by the work we did, as you mentioned, with Pfizer and Novavax vaccine, with the Regeneron monoclonal antibodies, and our longstanding work with Ebola. We're an organization that can bring that science right up to the pre-IND, IND stage. And as a result of our diversification of our business model and our ability to work nimbly and safely in the infectious disease space for so long, we need to modernize and grow our campus. And these investments become critical in increasing resilience and increasing capacity so that we can better face the next pandemics that we notoriously will have.
Where does the money come from to service these bonds, and how predictable is that money?
So the bonds come from diversified sources, and from our underwriters and the folks we've worked with. We understand that the market was hot and that we had 3.5 times the number of investors interested in this particular option relative to our needs. So this is really taking a critical look at end markets for infectious diseases, which are growing. Infectious disease is predicted to be the #1 killer of humans by 2050. And the time to really operate on building a safe society is really to do the work now. And so I think our investors understood that, and that's why they've come in.
Really appreciate your explaining all of this. Larry Schlesinger is the CEO of Texas Biomedical Research Institute, tapping the muni bond market. He runs the nonprofit, and of course, they have a lot of experience with COVID vaccines and Ebola vaccines. Still ahead, what investors need to watch for tomorrow. This is The Close on Bloomberg. We were telling you about our breaking news earlier, where Apple is set to get an OpenAI board observer role as part of its AI pact with that company. Let's bring in Bloomberg's Mark Gurman, who broke the news, to join us for more context. It's remarkable. Apple had absolutely no AI a few months ago, and now it has a board seat on OpenAI, albeit a passive board seat.
Yeah, yes, to be clear, it is a board observer role, and this person is going to be Phil Schiller. That's an Apple fellow. That's his title. He's the head of the App Store and the head of Apple's product launch events. He was previously, for well over 2 decades, Apple's marketing chief. He worked extremely closely with Steve Jobs on turning around the company. He was known as the biggest protector of the Apple brand, introduced the vast majority of Apple products over the past decade plus. He stepped down from that marketing role at the end of 2020 to take on just this App Store and events role, but he's still one of the top 5 to 10 executives at the company, strong believer in Apple's approach to privacy, wants to protect Apple's brand and make sure they're in business with the right partners. And specifically, you've seen some tumultuous times at OpenAI, right? And so it would make sense for Apple, with such a critical partnership, to want someone in the room to understand some of the decision making. So it would make sense that Apple would want that as part of this ChatGPT integration and Apple Intelligence. And of course, like I said, that man is going to be Schiller, the former head of marketing.
Hey, Mark, is Microsoft going to like this?
That's an interesting one. So Microsoft obviously has a revenue share agreement with OpenAI. They made a multi-billion-dollar investment several years ago with OpenAI. And OpenAI's infrastructure, or OpenAI's technology, runs on Microsoft infrastructure and really powers, the vast majority of AI features on Microsoft's platforms. Now, this is going to be interesting. There are going to be plenty of board meetings that talk about confidential information related to OpenAI and Microsoft future products and initiatives. And of course, Microsoft would not want Schiller, who represents one of their top competitors, in those meetings. So we'll have to see how that goes. But typically in those cases, board members or observers oblige and exit the room for those types of discussions.
Hey, Mark, we really appreciate it. Thanks a lot. Bloomberg's Mark Gurman on his scoop on Apple having a passive seat on the board. All right, coming up, we have Jamaica bracing for hours. Heavy rain, wind gusts 155 miles per hour. It could be as much as $1 billion in damages. Hurricane Beryl is barreling across the Caribbean. Want to get more with Brian Sullivan. He covers the storms for us for Bloomberg. Can we just walk us through how bad this could actually be and what we should be focusing on in the next 24 hours?
So Beryl is going to be a major hurricane by the time it gets to Jamaica. It may not be a Category 4, maybe down to a Category 3, but that doesn't really matter. It's going to be pushing a huge storm surge into the southern coast of Jamaica. And along with that, some really heavy winds. So there could be a lot of damage right along the coast especially, but inland as well. And if there's even a little jog in the track, Beryl could go right over the island and the price goes up from there.
It feels really early to be talking about a Category 5 hurricane so far this storm season. What does it say about the power of upcoming storms?
Everyone is frightened by that. You saw Swiss Re and Munich both took hits today in their stock price because people are afraid what the rest of the season is going to be like. This part of the Atlantic doesn't usually get active until mid-August, and here we are in July. Actually, Beryl was born in June, so, we're months ahead of where we should be.
Yeah, pretty scary stuff. All right, thank you so much. Brian Sullivan, who covers climate change and the weather for us. Of course, we're keeping an eye on Hurricane Beryl and the damage that it's wreaking right now across the Caribbean. All right, let's take a look ahead to what we're watching for tomorrow, because it is a half trading day in the U.S., but there's still plenty of data for investors to parse through, starting with earnings.
Yeah, we get Constellation Brands. I mean, beer sales, straight up. What are beer sales?
Appropriate for July 3rd.
Right? What are costs doing? What the demand is?
All right, so we'll keep an eye on, the sales of Modelo, for instance. We also have economic data. There's the weekly mortgage applications. That's a weekly thing on Wednesdays, but also some Thursday data pushed up.
Yeah, we got initial jobless claims. That could be quite interesting, particularly ahead of jobs on Friday. Yep. And then after the JOLTS number, which surprised to the upside, but then underneath it was really just about, say, government workers and those jobs opening that did really well. The private area in the JOLTS what didn't. So that'd be interesting to see how that read-through happens.
And there's also some ISM numbers as well, right? Services, which is the biggest part of the U.S. economy, not to mention factory orders, although we know the manufacturing economy is, in contraction mode, and durable goods, which tends to be pretty volatile. And we mentioned half day of trading. Actually, for a change, equities will be closed before the bond market.
Totally shocked. Did not know this was happening. Right? Really blew my mind. Right. So equities close at 1 p.m. The bond market closes at 2 p.m. because at 2 p.m. we get the FOMC meeting minutes. So we're going to be covering that for you right here on Bloomberg Television. Scarlett and I will be here from 12 until 2:10. So just definitely stay with us for that. I wonder what we're going to be looking through in the tea leaves for those minutes.
Yeah, well, Mike McHugh will be joining us. And of course, there's a lot of, we need to have the confidence to cut rates, not raise rates. We need to have the confidence, and about policy being plenty restrictive at the moment. And of course, setting you up for tomorrow's trading day, we closed at a record high. So we'll see if those records continue.
32 record highs so far this year, but without the fanfare, the melt up, as you called it. I think that was a brilliant way of phrasing it. Melt up, absolutely. 100%.
No one's wearing any
What's leading
hats
it
today.
Yes,
right.
No streamers.
That does it for us. Balance of Power is up next. Have a great evening. This is The Close on Bloomberg.